Hello guys, today we will talk about Tesla. Yes, Tesla, the market darling. So, will I like the company or not? What do you think? So, let's tune in the video. So, let's talk about Tesla. So, Tesla is not a company I usually follow because of two reasons. I read the book One Up on Wall Street by Peter Lynch. So, one of the things he says on the book is that you shouldn't follow the market trends. So usually there is no opportunities in the high flying companies. So when everyone likes a company, that's they most probably will be overvalued. So that's I don't like to waste my time looking into that companies. So but today let's see what Tesla brings us. So the second thing I don't like about this company, it's because it's a auto manufacturing company. So uh, other auto manufacturing companies like Toyota, Ford, GM, they usually have low margins, high high capital requirements for their uh, factories. Uh, so that's there is a sector that their companies they have a lot of risk, lower margins. So that's not companies I usually like. So, but on that companies you have Ferrari. So Ferrari have high margins, and they have a wide moat. So let's talk about Tesla. So they have a market cap of $500 billion, really a high P of 48, a forward P of 32. Um, what we like, they have a high revenue growth. They are growing a lot in the last year, so I really like that. I really like the company, so I will try to be a little optimist on my analysis. So, but we should be more conservative. So, but what we like, they have for an auto company. Yes, they are an auto company. Maybe there are a lot of people talking about they are a tech company. Yes, they have a really good technological. Uh, they have a really good tech on their cars. But if you look into their revenues in the last quarter, they had 20 billion dollars from auto sales. So and in a 23 billion dollars revenue. So their service it's only not even $2 billion, and their energy generation and storage revenue it's around 1.5 billion. So it's that might be 85% of their revenue is coming from selling cars. So that's a auto company. So I know they are growing a lot in their energy generation and in their service, um, and maybe in 5 or 10 years this sector of the will be a higher percentage of their revenue. But until that, that's an auto company. So sorry, Amazon. The revenue from e-commerce it's only 60% maybe or 70%, and they are still an e-commerce company, and most of their profits are coming from AWS and their advertising um, sector, and they are still an e-commerce company. So sorry guys. So what do you like? They are growing a lot. That's really good. If you ask me 5 years ago if Tesla can grow that, I might say no, but they are proving everyone wrong. So high gross margins. Uh, that's a cross, but for a car company, they have really high margins, and that margins can grow if their energy generation and their service grows. But on the other hand, they had really good margins on the last year. They had 15% net margins in 2022, but this year their margins are being around 10%, and even 10% that's really high margins for an auto company. So that's really good for them, but we have to analyze Tesla as an auto company. For an auto company, they have good margins, but for a company, their margins are low. So their balance sheet is really solid. That's a positive thing about them. They have low debt. They have a lot of cash in hand. Their return on invested capital has been really high now since they have been profitable in the last 2 years. So about their mode, that's why I have my doubts. For a auto company that can grow at this rate and have that good margins, they have to have some kind of mode. So, but is that mode wide? Uh, I believe they have a really wide mode, but their mode is decreasing. So as other companies um, are coming up to the market, to the electric cars market. So if Tesla wants to continue to grow at this pace, they have to continue to grow a lot, and they have to enter the Chinese market. That's why they are um, decreasing the price of their cars. I mean, so they can compete with BYD and the other car companies in China. So China is maybe it's not maybe, it's the biggest electric car market in the world. Uh, I believe it's over 60% of the world market. So they have to increase their market share there so they can continue to grow. If they can do that, maybe that's what they need to continue to grow. So my opinion about their mode is they have some kind of mode. I really like the cars, their technology, the tech behind their cars. So, but their mode is decreasing. But if you want to evaluate the mode, let's do an exercise. I've seen that on the social media, on Twitter. If someone pays you $20,000 for you to not buy a Tesla anymore, will you accept that? I will. If you give me $20,000, I might buy a Volkswagen, another car. So there is a moat. Yeah, their moat is not. Maybe it's not sustainable. So I know there are a lot of Tesla fans. I'm not the biggest fan of Tesla. I really like the company. So, but bear in mind that being the biggest fan, it's not always a good idea. So that if you are the biggest fan, that makes you being maybe too optimistic. So you have to looking into it as with clear eyes. So we are here not to support Tesla. We are here to make money on the stock. So we have to look into it as an investment. So that's what I am trying to do here. So they have been free cash flow positive now. They are making money now. That's really good. But they are not returning capital to the shareholders. They are not doing buybacks. Actually, for the last year, they are diluting the shareholders. They are not doing dividends. So we don't know what they will do in the future. But so let's talk about the most important part now, about valuation. So what should be our base case? I'm trying to be not too optimistic. So for my base case, I will do 10% margins. That's really high for a car company. So I'm expecting them to continue to grow their energy storage service and their service. I mean, so they can maintain their margins. So, they will have to have lower margin than they have in the past, because we might get recession. They have to enter the Chinese market, so they have to decrease their prices. So I believe 10% is really fair. It's not too conservative actually, because if you're looking into Toyota, Volkswagen, other car companies, they have margins around 5%, 6%. So that's why I don't like the market. But I'm doing a premium for Tesla here. They are expecting to grow into this year around 25%, 28%. So that's really high. So I'm looking into my base case around 20%, and after for the last 5 years 12%. Oh, that's really low. They can grow a lot. No, the revenue for this year is expecting to be $100 billion. If you grow at this pace in 10 years, there will be almost $500 billion in their revenue. Do you know what that means? They will mostly own the car company share, the market share. So that's a lot. The revenue will be really high. It's gonna be revenue in the Walmarts and Amazons at the moment. You really believe that? So I believe this is a little bit optimist, but let's look into it. And 15p, yes, it's low, but it's a car company. Car companies trade around 10, 8, even 6 PEs. So we are doing a premium here because we like Tesla. So for my bull case, if they grow around 25% and 14% after that, P of 17, margins around 12%. For my bear case, they can grow around 16% and 10% for the last 5 years. A P of 13. Their margins 8%. So bear in mind, for a bear case, they're still growing a lot. They have a PE of 13. For if you are looking to a tech company only, that's a really low PE. I admit that, but it's a car company, guys. If you compare to other car companies except Ferrari, we are doing a high premium here. So that's what I think. That's what I called it, looking into with clear eyes and with not a bias, because sometimes loving a company, it's not a good way to looking into an investment. If you really like the company, buy a Tesla, but if you want to make money and do a good investment, you have to looking into that conservative. So with that assumptions, our intrinsic value will be around $70. So Tesla is trading at 165, and bear in mind they're trading around their low. So they hit a low of almost $100 and everyone bought the stock. But I believe that's in the next year, for the next month, Tesla it's gonna be difficult for the Tesla shareholders, because that was a bad report last week. Their revenue decreased for the last quarter. We might get into recession, and you know what happens to car companies in recession. So they are a consumer cyclical company. When we have recessions, the people buy less cars. Sometimes when recession happens, the consumer will consume less. Car companies will sell less cars. So might get difficult times for Tesla, and at that valuations, they might get difficult. So I might get interested in Tesla if they trade around $70. I'm not buying that at $70 because that's not a conservative analysis. It's just an exercise to looking into the company at what price I might be interested. So maybe we never see that $70 price for the Tesla shares, but I can be wrong. Tesla can explode from that. They can grow a lot. They can do a little, do some announcements, good products, not that robotics announcement that was bullshit. But I can be wrong, and I can live with being wrong and not have my skin in the game. So, but I can't live with investing in that and the stock going down. So I'm here to trying to make money, trying to have good investments, and trying to share my knowledge with you guys and trying to help you. So that is my analysis. So there are a lot of people analyzing the stock. There are even more conservative people than I am. So that's just my opinion. I hope you find it useful. So if you like it, please subscribe. Bye guys.